Next question. The net sales of A Limited is rupees 30 crore. Earning before interest and taxes of the company as a percentage of the net sales is 12%. The capital employed comprises of 10 crore of equity, 2 crore of 13% cumulative preference share capital, and 15% of the debentures of 6 crore. So capital employed is consisting of the three sources of finance: equity, preference, and debentures. Income tax rate is 40% Calculate ROE, return on equity, for the company and indicate its segment due to presence of preferential capital and borrowing, that is the debentures. I request all of you to go through the question, please. Dear students, over here, the question says that you're required to compute the return on equity. So calculation of the return on equity is very simple. That is earning available to equity shareholders divided by equity share capital into 100. However, the question says additionally, and indicate its segment due to presence of the preferential capital and borrowing. So what does this additional thing mean? That is what we are going to discuss. So let us calculate the answer of the question, and with that we will have simultaneously its discussion. I request all of you to write down answer along with me. First question is very simple. Heading, write down calculation of return on equity. In the breakdown, working note number 1, calculation of earning before interest and taxes. That is the first working note. It is sales into 12%. Sales is rupees 3000 lakhs. Into 12%. 30 crore, that comes to 3000 lakhs. That comes to 360 lakhs. That is the EBIT. Working note number 2, calculation of return on equity. So in that, we'll start with the EBIT. EBIT is 360 lakhs less interest. The question is providing the information that capital employed comprises of 10 crore of the equity, 2 crore of the 13% cumulative preference share capital, and 15% of the debentures of 6 crore. So it is 600 lakhs into rate of interest is 15%. That comes to 90 lakhs. Earning before taxes, 360 minus 90, that is 270 lakhs. Income tax rate is 40%. So earning after taxes will be 60%. So 270 into 0.6, that comes to 162 lakhs. Less preference dividend. Information is given about the preference share capital of 2 crore, that is 200 lakhs, and the rate of preference dividend is given as 13%. That comes to 26 lakhs. That will give us earning available to equity shareholders. 162 minus 26, that comes to 136 lakhs. The same will be divided with equity share capital. Amount of the equity share capital is given as 10 crore. So it is 1000 lakhs. So finally, return on equity 136 lakhs divided by 1000 lakhs into 100, that is 13.6%. I request all of you to write down answer, return on equity. So this is the way return on equity is calculated. Okay. Now see, the question does not end over here. The question has a further a point. Let's say you're required to indicate its segment due to the presence of the preferential capital and due to the presence of the borrowing, that is the debentures. Now to compute the same, there are a few working notes that say we are required to prepare. I am preparing those working notes for you, and then we are going to understand from the beginning, let's say, why it is prepared. So I request all of you to write down answer along with me. Working note number 2, calculation of return on capital employed. In bracket I am writing post tax. Why do we prepare? We'll just understand in some time. It is earning before interest and taxes into 1 minus t divided by equity share capital plus preference share capital plus debentures. That is what we understand is a capital employed. Dear students, we understand, let's say if at all the reserves and surplus would have been given, then it would be included as a part of the capital employed, because this is basically understood as capital employed. Earning before interest and taxes 360 lakhs into 1 minus tax rate 0.4 divided by equity share capital is 1000 lakhs, preference share capital is 200 lakhs, and debentures is 600 lakhs. Into 100 for getting answer in percentage term. So it is 360 into 1 minus 0.4, that is into 0.6, that is 216 lakhs divided by total of all of them is 1800 lakhs into 100 for getting answer in percentage term. 216 upon 18 into 100, that comes to 12%. Please write an answer, return on capital employed. Next, working note number 3, calculation of KP and KD. So as far as the KP is concerned, it is preference dividend divided by amount. We have been provided with the information that the preference dividend is 26 lakhs divided by 200 lakhs. That comes to 0.13, that is 13%. Why do we compute? I'll just come to that point slightly after some calculations. Dear students, this answer can also be found as KP is equal to preference dividend. That's it. Why? Because so there is no premium, no discount, no flotation cost. That is the reason. The next is the KD. It is interest into 1 minus T divided by amount. The company is raising the debt financing of an amount of 90 lakhs into 1 minus 0.4 divided by amount of the debt financing is an amount of 600 lakhs. So 90 into 0.6, that comes to 54 lakhs divided by 600 lakhs. So 54 upon 600, that comes to 0.09, that is 9%. Or otherwise, we can say that's the rate of interest into 1 minus tax rate. So 15%, that is the rate of interest, into 1 minus 0.4. 15% into 0.6, that comes to 9%. Now the important point of the question starts. Dear students, basically the term return on capital employed is indicating what is the rate at which you are able to earn from the business. See, the capital employed is consisting of all long-term sources of the finance taken together. Means, listen carefully, means whatever the total funds that we have employed in the business is able to generate collectively a return of 12%. Whatever may be the source from which you have raised the funds, you will be able to earn at the rate of 12%. That is what this return on capital employed is indicating. Now we understand that, listen carefully, the total funds that we have employed in the business is 1800 lakhs. This 1800 lakhs is having, so the division like this. We are having, say, one source of the finance as equity, another source of the finance as preference share, and the last source of the finance as the debentures. So here it is equity, then it is preference share, and then it is debentures. As far as this 1000 lakhs is concerned, or this 200 lakhs is concerned, or this 600 lakhs is concerned, all of them are able to earn at the rate of 12%. We understand that, say, as far as the preference share is concerned, it has a cost of 13%, which we have calculated above. Debentures have a cost of 9%. Again, that is what we have calculated above. So what will happen, dear students? The initial 1000 lakhs, the equity 1000 lakhs, in that, say, you don't have to pay to, that is anything to outsider. And you have the earning of 120 lakhs available with you. With the introduction of the preference share, you earn at the rate of 12% and your cost is 13%. So basically, the issue of the preference share capital has a loss of an amount of 2 lakhs. It is 1% of 200 lakhs. And for the debentures, 3% on 600 lakhs. So you get a return of an amount of 18 lakhs. Because see, you are having a surplus, you earn at the rate of 12% and your cost is only 9%. Okay, so what will happen? We understand like this. This 2 lakhs is having a loss. This 18 lakhs is having a surplus. So overall, due to introduction of the outsiders financing, you have an advantage of 16 lakhs. You have an advantage of rupees 16 lakhs. That is what we understand. Your own funds is able to earn 120 lakhs. Due to outsiders financing, you have advantage of 16 lakhs. So overall, what will happen? The equity shareholders will have 120 plus 16. So the total earning that say they will be having is 136 lakhs. How this 136 is calculated? 120 plus 16, that is 136 lakhs. What is the amount of the investment by equity shareholders? It is 1000 lakhs. So that will give us, listen carefully, that will give us a return on equity. It is 13.6%. How this 13.6% is calculated? It is 136 lakhs divided by 1000 lakhs into 100. This is the way the return on equity can be cross verified, and that is what they have provided to us an example. You can see that the question says that you have to compute the return on equity, and the question does not end over there, and indicate its segment due to the presence of the preference share capital and borrowing, that is the debentures. So we can say that, say, whatever the return of 13.6%, in that, say 120 lakhs is what you are able to earn for your own investment which is made, and this 16 lakh rupees is what you are able to earn because of the introduction of the committed sources of the finance, and it is given a technical name as the advantage of trading on equity. The 16 lakhs is considered to be an overall advantage of trading on equity. That is what we understand. This is not only for an understanding purpose, but it is forming part of the answer. So I request all of you to write an answer of this 1800 lakhs bifurcation. Please write down further answer. Based on above working, comma, we conclude that equity shareholders have an advantage of issuing debentures. Further write down, they have a loss for raising preferential capital. Full stop. Overall, there is an advantage of raising outsiders finance. Full stop. With paragraph write down, post-tax return on capital employed indicates that what is the rate at which a company is able to earn irrespective of source from which funds have been raised. Full stop. If it exceeds post-tax cost of capital, comma, equity shareholders will be benefited, not otherwise. Now, just for understanding purpose, suppose the company is only redeeming the preference shares. Why? Because the cost of preference share is more. Then in that case, what will happen? Just having that understanding. See, 360 divided by 1800 into 1600. Why? Because we have the redemption of the preference share capital. This is 320. This is 90. So this is 230 into 0.6, 138. Now this is 0. So this is 138 divided by again 1000 into 100 for getting answer in percentage term, and without doing anything else the return increases to 13.8%. This is what we understand. So only redemption of the preference share capital, which is having say the higher cost, will be able to give increase of the return to the equity shareholders. So summarizing the entire answer, in the first question we are required to compute the return on equity, in which first of all we'll compute the operating income. It is sales into 12%, that is 360 lakhs. Then we are computing the return on equity by using the normal concept that we have of the ratio analysis. EBIT minus interest is EBT, minus tax is EAT, minus preference dividend is earning available to equity shareholders upon equity share capital will give the return on equity. The second working is the calculation of the return on capital employed post-tax. Because we want to know that is what is the rate at which we are able to earn from the business, irrespective of the source from which we have raised the funds. That comes to 12%. Next is calculation of the cost of preference share and cost of debenture. It is 13% and 9%. The total amount is 1800 lakhs. That will have the three financing: equity, preference and debentures. As far as the equity is concerned, it is 1000, preference is 200 and debenture is 600. We earn at the rate of 12% irrespective of the source from which you have raised the funds. What is your cost? In case of the preference share, it is 13%, and in case of debentures, it is 9%. So basically, there is a surplus due to debentures and there is a loss due to preference share. Overall, there is a surplus of 16 lakhs, and that contributes in terms of increase in the return to equity shareholders, and it increases to 13.6%. So this is the conclusion that we draw. Dear students, in my opinion, that this is a conceptually a very good question, a very good question, in which as a student you understand that say when a company is raising the outsiders financing, what kind of advantage or what kind of loss that the company may have.